House prices to jump 20% with growth expected next year, says ANZ. ANZ has tipped house prices to jump more than 20%, lifting its forecast despite the lockdowns off the back of a stronger than expected property market. There are plenty of locations that have been locked down in recent times and are still in lockdown at the moment. I know that people in the Sydney and greater region are in a lockdown. So pretty much everyone in New South Wales is stuck in their homes and can't really go anywhere or do any activities at the moment. But other states and other locations have plenty of freedoms, such as Perth hosting a grand final. And up here in Brisbane, we've got a pretty relaxed set of rules and lifestyle at the moment where we can actually go and play community sport and enjoy, cafes and restaurants. So we're pretty lucky up here to have that. Mask wearing is still the case all the way across the country, but this lockdown and this lockdown lifestyle hasn't really stopped or halted the growth that's been going on in the property market. It's only really fueled it. People have been saving money, been wanting to invest the cash that they've saved. So property's been going through a massive boom this year, and ANZ's tipping some growth in 2022 as well. So property prices are expected to rise 24% in Canberra by the end of this year and 23% in Sydney and Hobart, according to the bank's latest forecast. Gains of 21% and 20% are expected in Brisbane and Melbourne, respectively. So that's basically the whole of Australia. Every major market, that's what they pretty much listed except for Adelaide and Perth, but all other major markets are expected to receive above 20% growth this year in 2021. That is a massive amount of growth, and I'm sure there's plenty of people out there struggling to get into the market. I know it's a difficult time if you're looking to buy, and it's hard if you're trying to get into the property market at the moment because prices are rising faster than people can save. It is a difficult property market to get into, but as we're seeing, there is growth there, and there's growth expected to continue into 2022. ANZ is the latest of the big banks to revise their forecasts upward amid the lockdown, which ANZ senior economist Felicity Emmett said were unlikely to derail the strength of the housing market. So ANZ has said when you look at some of the leading indicators, auction clearance rates, sales to listing ratios, you can see the market is still very, very tight. There hasn't been much drop off in demand or interest in the face of heavy lockdowns. So what we're really seeing here and what ANZ is saying is that we've still got a supply and demand issue. There's not enough supply, so if you're looking to sell your home, now might be a great time. And there is excess demand. So lots of people trying to get into the market at the moment. And again, when you've got less supply and high demand, the market's going to increase and prices are going to increase. So this graph is a house price forecast by Capital City. And you can see from 2018 all the way through 2022, the house prices year-on-year percentage change. So what was the movement in property prices in that year? So I'm going to narrow in on Sydney, Melbourne and Brisbane just for a bit of a comparison over the last 5 years, or sorry, I should say last 3 years with a 2-year forecast. So you can see that property prices fell in Sydney and Melbourne in 2018 in the light blue. In 2019, they grew. 2020, they'd fallen slightly in Melbourne and barely had much growth in 2020 in Sydney as well. Now, we've seen massive spikes, so over 20% in Sydney, Melbourne and Brisbane in 2021, but the forecast across all the major capital cities has pulled right back around the 5 to 9% mark in 2022. So essentially what we've seen is a year of massive boom, and I don't want to say it, but you might be too late to ride the boom growth that we've had in these markets. If you're looking to purchase now, you're going to get the tail end of the growth. That's what I expect, but it still might be a good time to buy. If you're planning to buy and hold for the long term with good fundamentals, buying into property and making a property purchase now will see you in better stead than buying in 12 months' time after all this growth's occurred. So essentially what ANZ and the other banks are forecasting is looking at the massive growth that we've had over 2021 and expecting that to go strongly out to the end of the year, and then a pullback growth of 5 to 9% next year, which is not a boom market, but that's still fantastic growth. If you could get 5% on a $500,000 property, that's $25,000 worth of growth and equity that's building into your property portfolio. So it's nothing to turn your nose at. These updated forecasts are in line with what CBA have been saying earlier this month. NAB's also got a similar forecast in July, which pegged house prices to jump 18.5% in 2021 and 3.6% in 2022. So really all the major banks are saying similar things, but you've got to take this with a grain of salt. All the banks were predicting house price crashes before the government intervened, and we had the play out of the lockdowns, an environment that we live in now. So things may change, and economic policy may change, and cash printing by the government may change, and demand might change. So there's so many factors that go into making a forecast in terms of growth in property. Take it all with a grain of salt. But I would have a bit of confidence personally in looking at the growth that we've had and what the banks are forecasting, say that it is fairly reasonable that we're going to have that growth of 5%, 5 to 9% in 2022. Now, while momentum would slow in 2022 due to the affordability constraints, higher interest rates in future years would really be the circuit breaker for the property market. What ANZ is saying here is that although 2022 is going to be slow growth, when the federal bank decides to increase interest rates and the market goes up in terms of repayments and money that people are having to pay back to the bank to hold their portfolio, people are going to be able to access less money, and that's going to make it more difficult on people's cash flow. All of that is going to lead to reduced demand and see growth come out of the property market in terms of property prices. So when you're running your own numbers for your property portfolio, take this in mind and build in a buffer. Interest rates will increase at some point down the track. It might be 1 year, it might be 3 years, it might be 5 years. It could change at any point in time. So build in buffers to make sure that you have a rainy day fund and that you're comfortable when interest rates could potentially increase. I know lots of people have sub 3% rates at the moment, which are historic lows. So build in a buffer of say 4.5% or 5%. Can you continue to make your repayments on principal and interest at 5%? And would you be comfortable doing that for the long term? Now, the article goes on to say here that household debts are at concerningly high levels with the low interest rates that we now have. And this has enabled people to make repayments in this market on a large amount of debt. Almost 40% of owner-occupiers with mortgages have over a year of prepayments in their loans or offset accounts, as do a third of investors. Housing debt as a multiple of household income was also down a little from its 2019 peak. So what it's really saying is people have more debt because debt is more affordable these days. You can hold more debt because the interest rates are lower. But as I was saying earlier, make sure you understand your long-term plan and whether you can handle fluctuations in rental income and also in your expenses, which the biggest expense you're going to have is your interest repayment back to your lender. So do some sensitivity analysis on your portfolio and get comfortable with your debt. Don't stress yourself out. So how can you practically apply this economic forecast and what's going on in the property market into building a plan and building a property portfolio? So really what I would be doing, and this is not financial advice, but what I would be doing, seeing the growth that the market's had this year in 2021 and looking towards moderate growth in 2022, I would still be considering to make a property purchase this year and next year. And really, I would weigh up what kind of value you can get in the market and what areas haven't quite seen huge growth yet. Some suburbs are going to have higher growth than others, and what are the fringe suburbs that could boom down the track or have long-term growth potential or value add potential as well, that you can actually manufacture some value instantly out of that property. So I would really assess where I see value in the market at the moment, and that would be completely dependent on the price point I could purchase at. So if I was purchasing at a $500,000 price point, I would be looking at Adelaide and Brisbane. So if you're actually looking to buy in Brisbane and you're wanting help in terms of buying into the property market, I run a buyer's agency up here in Brisbane called Purpose Property, and we help people buy property in the Southeast Queensland market. If you're just looking to have a chat, we run free strategy sessions where we sit down with you, take a look at where you are now, what you want to do in your investing journey, and where you actually want to end up. And by all means, you can go out there and do this on your own. I try and provide value and free content on the YouTube channel, or you can come on as a client and we can work with you and journey with you in building out a property portfolio. If you're interested in seeing more videos on the property market, click here.